Thank you very much again for joining me here this evening. We're going to be talking about passive foreign investment corporations. So a little bit about me. I'm a tri-citizen of the United States, Australia, and the UK. I grew up in Australia, moved to the United States in 2005, worked as a corporate financial analyst for a number of years before I saw the light and realized there was a way to work in a white-collared professional capacity with a fiduciary obligation to my clients in a fee-only capacity, fee-only meaning receiving no commissions. And it was at that point that I swapped over to become a financial advisor. I've been an instructor at UC Berkeley Extension, Golden Gate, and I'm a regular speaker on the conference circuit. All right, Arete Wealth Group, what are we all about? Essentially, we consist of two brands, Arete Wealth Australia and Arete Wealth Strategists. Arete Wealth Strategists Australia, as you'd guess, is focused on the needs of Australian expatriates located in the United States or Americans in Australia. And Arete Wealth Strategists is focused on working with domestic business owners. So we're really in our sweet spot working with Aussie expat business owners in the US. Okay, you might think of us as the general financial contractor, where we're able to assist people with all manner of different financial topics. We have an expert network in Australia, deep resources there, where we can reach out and of course the United States as well, even more so here, where we can reach out and make the appropriate referral given the client's circumstances. And as I mentioned before, do so with no fee. We're simply operating in the client's best interest. I really define there being three types of Aussie expats, or really expats from anywhere. You've got your short stayers, people on working holidays. You've got your domicile uncertain, and you've got your permanent movers. Really, we do our best work with the permanent movers. We also provide advice to the domicile uncertain, given they don't know where they'll end up being. Excuse me, we provide three services: situational advice in the form of a statement of advice, provide comprehensive financial planning on either a project or subscription basis. Difference there being assistance with implementation. A subscription engagement is particularly well suited to someone with a degree of uncertainty in their situation, where there may need to be a changing of plans. It's not, they're not set on a level trajectory. And the third option here is, of course, our premier service offering, and that is wealth management, which is investment management and comprehensive advice all in one for clients for whom we manage more than $350,000. That is offered with no additional charge. Okay, other announcements. It's been a busy year of travel. Most recently got back from Brisbane a little over a month ago. I'll be speaking in St. Louis at the XY Planning Network conference in 2 weeks. FPA National Conference, I'll be hosting, I'll be on a panel with the International Knowledge Circle, where we'll be talking about the need for global financial planning designation. Off to Sydney in November to go to the FPA Professional Congress. That's the Australian FPA. And I'll be doing research for an article I'm writing for Michael Kitsis, who's one of the most widely read bloggers and thought leaders in the financial planning world. And other announcements, our new website is up, so yay. All right, outline of tonight's presentation. First of all, we're going to talk about what is a PFIC, what is a passive foreign investment company, and to whom is this relevant? We'll look at the history of PFICs, how did they come to be? What is the tax treatment for owning a PFIC? Three different types of treatments you might incur. There's the qualifying electing fund option, the mark-to-market approach, or the excess distribution approach. How can I shape my investment strategy to avoid investing in PFICs? That's really the golden question here, the million-dollar question. As you'll see once we review the different types of tax treatments, does PFIC regulation affect superannuation accounts? Also some uncertainty over the question there. And where can I learn more? Okay, so what is a PFIC and to whom is this relevant? So really any non-American company that generates most of its income from passive sources. Passive sources would include such sources as dividends, interest, rents, royalties, and capital gains. Specifically, the way the rules are written, it's either if 75% or more of a company's income is passive, or if that company, while it may have active income, if more than 50% of its holdings are set to generate passive income, then it's considered a PFIC as per the IRS. A lot of times, I think it's disbelief that causes clients to say, well, hold on a minute, what could that possibly include? And the answer is very simple. Essentially, if you don't own individual stocks or bonds, then it's probably a PFIC. So as you see here, all, underlined, all Australian or any foreign managed fund, ETF, money market fund, real estate fund, you name it, possibly even superannuation funds, depending on the interpretation you take, fall squarely in this definition. Therefore, if you're a US citizen, green card holder, or otherwise satisfy tests to become a US tax resident, namely you satisfy the 183-day substantial presence test, then you are subject to this very complex set of rules and complex and punitive set of rules that will determine how your foreign managed funds will be taxed. And it kicks in at a fairly low level. So 25,000 individual or 50,000, you're required to disclose and complete Form 8621. And that's irrespective of any activity on that fund. That's simply if you own it and it's worth more than that, you've got to comply with this. I do want to say, what is how rigorously is this enforced? The IRS go to lengths to make sure that they don't set a bottom threshold under which they announce that they don't bother enforcing it. Why would they do that? That would make it so easy for people to not comply and ignore their rules. So essentially, investors of all sizes can be audited and can be subject to penalty if they fail to comply. Likelihood of that for a smaller investor is probably fairly low, but we would never advise a client to not fully and completely comply with the law. Okay, so how did these PFICs come about? They came about as a result of the 1986 Tax Reform Act, purpose of which was to eliminate the beneficial foreign treatment of certain foreign investments. And the way that the foreign investments were beneficially treated was that they could simply accrue their earnings within the foreign fund, and then at the time of sale, treat all those accumulated earnings as capital gain, taxed at a lower and preferential rate, compared with the US funds that were required on an annual basis to declare all income and pay tax on that income, often prior to the early 2000s, when qualified dividend distribution rates came in. The income that was declared was much less preferential than that long-term capital gains treatment. So consequently, the US funds were at a significant disadvantage, and they went about lobbying and had PFIC rules introduced. So thought being that they're on more of an equal playing field. That's probably not the case. It's probably the case that they've completely turned the tables, would be a more accurate way of describing what's happened here. So how might you comply with PFIC reporting? Here's how it works, one of three ways. You either have a qualifying electing fund, and we'll talk about that here. Essentially, your foreign mutual fund or managed fund is going to follow the rules of the IRS and declare the proportional income and capital gain that your particular shareholding experienced over the course of that year. So it's also not as favorable as domestic treatment, given that any dividends that you would receive are going to be taxed at your marginal rate. And for pretty much anyone making over, what is it, $38,000 this year, filing joint, you're going to be paying more as a result of this PFIC treatment, even if it's a qualifying electing fund. But here's the kicker, is that with a qualifying electing fund, very few foreign funds even satisfy this criteria. So even if your fund did, it's likely that it's not the most competitive fund. It's not what one would choose if they were following a fiduciary quality approach in choosing the funds that comprise a client's portfolio. So you probably don't have a great performing fund anyway, but it's not taxed nearly as bad as what we see here. Mark to market, that's the next approach. That's essentially mark to market, I would think, is fairly self-explanatory. January 1, what is the value? December 31st, what is the value of that same fund? If there's been any income or capital appreciation, that is all treated as ordinary income in those years. Really unfavorable. So that's really going to hurt an investor if they get treated with mark to market. Excuse me. So while it opens up a broader range of investment choices, it's still nowhere near as good as you might get if you were able to avoid PFIC treatment entirely. All right, and worst of all, excuse me, I'll just give an example of a client who we're just going through this right now. Actually, he's filing his return. The fund has been liquidated. The tax has been assessed, and here's what it looks like. So I have a client, US citizen, lived in Australia for a number of years. Back a dozen years ago, he bought some Vanguard funds. They did very well. In fact, they doubled, or actually slightly more than doubled. So he was very happy with that, but was less than happy when he was assessed a tax bill of almost 50%, not quite, but almost 50% on a mark-to-market basis, because these funds were not qualifying electing funds. Therefore, all that income was taxed at his marginal rate. He happened to be a higher income earner, was taxed at that highest marginal rate on the entire gain. So numerous tax returns had to be refiled as well, and I might not have made that point sufficiently well on the previous slide there, that the tax administration is another, quite aside from the tax itself, the accounting is quite burdensome as well. All right, excess distributions, this is the worst of them all. So if neither election is made, that PFIC will be considered a Section 1291 excess distribution. And what's that mean? Essentially, it means that the sale of PFIC is thrown back over the shareholder's holding period and subject to tax at the highest marginal rate available in those given years. Holy moly! So, here's more of a detailed description. I'm not going to get into this first bullet point, but given that it's even more complicated than what we need to be involved with here tonight. But any capital gains that result from the sale of the PFIC shares will be spread out over the course of that shareholder's ownership period and taxed at the highest marginal rate available over that time. Here is an example of that. So let's say an Australian resident buys 100 shares of REM company, PFIC, on the 1st of January 2010 for $1,000 per share. That's $100,000 in total. This fund pays $80 in dividends every year, and then 3 years later, the fund sells for $250,000, achieving a capital gain of $150,000. So the way that will be treated is $50,000, that we divide up that $50,000 gain over the holding period. It was held for 3 years, so it's $50,000 of income per year. Now we get to tax it at the highest marginal rate that was available on ordinary income for each of those years. So all in all, and let's not forget state taxation. I've got many clients in California and New York, and those state taxes in those states. Don't forget that these tax treaties and these tax treatments also apply at a state level as well. So we could be talking about 50% marginal rates on these numbers. And as you may have gathered from the preceding example with my client, he also had a California state tax apply, which got him to nearly 50% there. So very, very nasty. And then to add insult to injury here, you see that the taxable amounts are allocated to the investor's tax liability without regard to any other tax characteristics, which means they could be in possession of current losses or net operating carry forwards, but can't use them. Sorry, they have to pay that additional tax bill. So what is the point I'm coming to with all of this? The easiest way to avoid all this nonsense is to simply own individual stocks and bonds. Okay, well, that's all well and good, owning individual stocks and bonds, but now we introduce another problem. How do we manage a portfolio of globally diversified stocks and bonds if you're resident in either Australia or the United States? That's a pretty intensive undertaking right there. Before we get to the answer for that, let's just briefly mention something here. So while there's a lot of debate about whether PFICs apply to registered or qualified accounts like superannuation, the IRS has not issued guidance on whether they do or not. So to be honest, I've heard many intelligent CPAs and tax attorneys opine in either direction. I have heard of very few people, on the other hand, that have received any sort of audit that has included fines on their superannuation account. That being the case, we operate with an abundance of caution and recommend a superannuation provider that does invest in individual stocks and bonds, which has the added advantage of lower costs, but also provides some safeguard from this PFIC treatment. Where can you learn more about this? Well, so happens we're in the process of putting together a white paper talking about precisely what I've spoken about here tonight, and we have a one-page fact sheet just talking about what PFICs are about. Going back to my previous point, however, about how do you avoid PFIC classification entirely, answer being you invest in individual stocks and bonds, you'll see here a client return summary from the Premier Global Reporting package that we use, Morningstar Office. You can see here this demo client has a number of different holdings, including they also hold superannuation accounts and brokerage accounts in Australia. Doesn't look like that's actually showing up on the summary list here, but we do see it on the next page. We see here the PFIC compliant superannuation program reported in Australian dollars, as you can see, and his US 401k also reported in US dollars, but rolled up into the base currency that we want to report it in US dollars. Very, very cool that we're able to do that. Another thing that we are just in the process of releasing, in fact, one of my staff was working on this all day today. We are releasing the very first fact sheet for Aussie expat clients. So this contains on one side, on the blue side, thinking of the Stars and Stripes there, on the blue side, we've got the US tax information. And on the green side, representing Australia, is the Australian tax information. So where this will be on our website, will be on the media, key financial data. Currently, it's just the US one, but we're going to get this up, we promise, in the next month. And that's tonight's presentation. Thank you for joining me here. Upcoming events or upcoming travel, as you see here, is listed. And please reach out to Arete-WA. Contact us if you're interested in scheduling an appointment to see how we may be of assistance to you. Thank you very much, and have a good evening.